Welcome to A Few Minutes with Peter Grandich. I'm your host, Al O'Grady, and for the next few minutes, we'll be talking to Peter, getting his insights on the markets, commodities, business, politics, sports, and life in general. Now, Peter Grandich is the editor of the Grandich Letter, which was first published back in 1984. He has been a market strategist, portfolio manager of 4 hedge funds, a mutual fund that bared his name, and is widely known for his accurate forecasts and no-hedge markets perspective. He appears regularly on television and radio and is widely quoted in leading financial publications. He's also the co-founder and managing member of Trinity Financial Sports and Entertainment Management Company, an insurance and real estate planning firm specializing in servicing professional athletes and entertainers. As always, Peter, welcome back to the program.
Good to be back, Al.
Okay. Peter, we were off for a couple of weeks. We had the holiday, 4th of July where you are, 1st of July where I am, because of holidays and so forth. But we are back in the saddle. So let's get up to speed on the markets, and let's start with the U.S. stock market and your take on things right now.
Well, it's more of the same. On one hand, it's trapped by a weakening economy, which doesn't give any real reason for expectation expansions on PEs, meaning corporate profits, at best can hold their own and at worst could decline. It is buffered, and I think I would be nervous if I was short. I haven't been, still don't believe it's a market you want to short because despite an array of problems both overseas and in the U.S., the market's not that far from 13,000 on the Dow. And what that suggests to me is with all the bad news, it seems a lot of it's priced in, and what if there's going to be any good news? Now, I don't think there's going to be a lot of good news, and that's why I don't think it can go substantially higher, but I still leave that possibility that we can muddle through and possibly make a marginal new high, which would be the ultimate shorting opportunity if it would happen. So the U.S. stock market, I think is at best is going to be 5 to 10% on either side where it is now come the year end. I do think there's more interest developing outside the U.S. and outside of North America, but I still think those markets that I'm looking at still need another 10 to 15% declines before they come attractive.
Okay, a number of follow-up questions here for you. You had mentioned PE, price-to-earnings ratio. That fundamental, does that seem to matter anymore?
Well, to go into a bigger picture and digress a little, one of the biggest concerns I have now is the apathy that seemingly investors, institutions, and regulators and responsible people in government all seem to have gotten to the point where it really doesn't seem what matters. A week doesn't go by when some sort of scandal, this LIBOR scandal, is the ultimate one. I think it's perhaps in the top 3, and yet it's still not getting any real traction to be a real concern by people. It's almost an acceptance. Well, that's what happens. That's how, things work. And so what? Banks were scheming to fix interest rates. Well, so what? It impacts us all in a big way. I also think that while it bodes well for the small group of us who have claimed manipulation doesn't stop at the door at the COMEX, it also has gotten people so desensitized their actions that it's just a throw up in people's hands in the air now. And that's why, because there's always a major tilt on Wall Street to be biased to the long side, that in that type of environment, that they could actually still move the market higher because people aren't really looking and seeing and accepting and acting on how really bad things are internally. So it sounds silly, it sounds stupid, but that's, whoever said it, people were brilliant that were running things on Wall Street.
Okay, 2 other follow-ups, and then we'll move on. My take is that we're right in the heart of summer. The markets are certainly very soft. Do you think it's just a time where, we'll wait for the summer holidays, people are on vacation and so forth? And is also, do you feel that there's more of a wait-and-see approach in the markets, waiting for for the U.S. election to see what transpires after that?
Well, I think the U.S. election is going to start to play a role after our Labor Day period. It has to. It's a critical one to the diverse camps. I am perhaps among the most dire anti-Obama types, and then there's still a camp that of extreme support, and the roads go dramatically 180 degrees different based on whether he's reelected or not. And so, yeah, I think that'll play a role. But I want to emphasize that it's kind of like, I don't know, you can take it to a football game or a boxer where everybody's expecting one side to do something to the other, but you get through the latter rounds or into the fourth quarter and the expectation wasn't lived up to, suddenly the reverse happens. And that's what I think is happening in the U.S. stock market. Despite all the bad news, despite all the justifiable reasons to want to diversify away from equities, the market has a chance to rally here. Now, part of that also, and this is probably going to eventually lead to another main topic question of yours, is I think it's coming even hard for the most ardent bull to keep putting new money into the bond market when yields are so low. And just some of that money coming out of bonds is going to give an underpinning to stocks. Because remember, Wall Street kind of works in this always cup half full of mentality, and their asset allocation is just stocks, bonds, and cash. So I think you'll see a lot of the allocators, particularly if we hit my target of 1.25% yield on the 10-year, move out of bonds and put that money to work in the stock market. And so that's what I think also underpins the U.S. stock market for the time being.
You touched on bonds, and we'll get into that in just a second. One last question regarding the markets. Where would you say we are right now in terms of the business cycle? Are we in recovery? Are we in recession? Or dare I even use the D word? Your thoughts?
Well, I don't think the standards, economic standards that were applied 10, 20, 30, 40 years ago just can't be applied anymore for a number of special factors. I don't, if this is a recovery, I would feel very sorry for patients that would have to face recoveries like this.
Right.
Depression, I don't know. It's kind of hard to talk about depression when expansion of money supply is, continuing, and I just think we're muddling through. And the problem is that we've spent so much, we mortgaged our future by creating so much money now to give us really anemic economic rebound, that sooner or later, as it was seen in Europe, that you just can't keep issuing debt and not pay a price for it. As I've always said, we're going to be the next Europe. I don't know what date that is, and so I just think that if this is strong economics, like I put something up on my blog today, which I thought was very disturbing. Not at the people who are collecting, but the fact that we had more people come on the disability rolls than the employment rolls in the last several months. And that goes to a bigger issue, which you can debate at another time, is how bad the entitlement situation has come in the U.S. But when you got more people going on disability than getting new jobs, how good can the economic rebound be?
Oh, that's interesting. All right. I think that's another topic for another time. You were touching on bonds. Let's focus our discussion there. I know you're looking for a 1.25% yield on the U.S. 10-year bond to get what you called aggressively short. Now, is that still the case?
Yeah, I think it's coming. I think, as you noted, the anemic economic rebound is going to continue to allow that Treasury yields to drop, and I think at that point in time, for me, and I only speak for myself because I can't give other people investment advice, I think it'd be very hard not to want to get aggressively short the market. And I think the best way when that time comes is through the exchange-traded funds that take advantage of a bond market that will weaken over time. So, yeah, I don't think we're there yet, and, I do think before year-end we'll get there. And at that point in time, it would be very difficult to not want to get in a position like that.
Okay, you were saying maybe not the right time for shorting the market, but many moons ago you were talking about shorting the U.S. dollar if the index got above 84. Is that still the case today?
Yeah, I think so. I'm looking at it. We're here over 83. And I want to point out, and this is an important factor for people who watch currencies, that there's been a dramatic difference between the movement in the U.S. dollar index and what is known as the trade-weighted dollar index. And why that's important is the U.S. dollar index is an unbalanced index, whereupon the euro, I think it's 6 currencies or 7, I can't remember, that make up the index. The euro is by far makes up the largest single component. So movement in that currency makes the index move more one way or another than a trade-weighted balance where all the currencies that make up that index are weighted evenly. And so it appears when you look at the U.S. dollar index that there's been a fairly decent rebound, if you want to call going from 140 down to 70 to rebounding to 83 a rebound. But when you look at the trade-weighted dollar index, it's still actually going lower because it takes into things like the yen and others which still remain very strong against the U.S. dollar. So, yeah, I think if we can get a little bit more pop in the U.S. dollar versus the euro, and that index gets above 84, I would certainly contemplate establishing a short position.
Now, you mentioned rebound. Is it the fact that the U.S. dollar is getting stronger, or is it the fact that the euro is getting weaker? I mean, it's all relative.
The latter.
The latter.
It's all the latter. It's not because people see just the U.S. doing so much better. It's, Europe is still a focal point. It's far more further on in its problem. It's at the acute stage, and it looks bad. But we haven't even begun to come to gripes with the debt problem that we have here in the U.S. And again, I'll point to a blog post earlier today of Peter Schiff speaking an interview that I found a lot of commonality in my own thoughts. And, he speaks of the same kind of outlook that it's not too long from now. It's only a matter of months or a year or two before we have a debt crisis that both he and I are apparently see even worse than the one we've already been living through in Europe.
Okay. For those that are trying to find where there is a safe haven as far as their investments are concerned, some look at gold. But gold seems to be stuck in neutral, and it has been for some time. Is that a good or a bad thing?
Well, there's a battle going on. And again, I want to point out because there is a camp that I've always been a part of, not on the moment-to-moment, hour-to-hour basis, but in the overall view, that felt that the gold market was manipulated. And I scoffed, especially at the perma bears who have an atrociously bad record, who would make the most fun of those of us who think so and, claim we're kooks and tinfoil hats and gold bugs and things of that nature. Yet a week or a month don't go by where we continue to see markets after markets showing evidence of being manipulated, most recently the LIBOR. And you have to stop and say to yourself, my God, if banks manipulated and conspired to fix interest rates, why on earth would they not want to have some influence in the gold market, especially since gold has been a barometer for a few thousand years and has always been a judger of what the people are supposedly thinking of the value of paper money, which banks and others make their livelihood off of. So it's really ridiculous to continue to hear people who scoff at the people that claim manipulation, whereupon we just continue to see evidence of widespread manipulation in every other market, and more increasingly evidence in both gold and the silver market being manipulated. So with that in mind, we are in a battle right now. I think it's become blatant. You have to live it and breathe it, but I believe we're just seeing blatant interference in the gold and silver market. But the underpinning of such strong physical demand has made it a pitched battle. And, I've long argued that there's two distinct different gold markets. There's the physical market that begins, based on Eastern Standard Time, early evening between 7 and 8 in Asia, and goes to about 11 o'clock in the morning Eastern Standard Time when physical buying in Europe comes to an end. And then the really only trading is the paper market on the COMEX, where I believe uh, the manipulation takes place. And what's happening is there's two distinct lines of support and resistance that have been drawn now, perhaps the most since this bull market began. And that might be an underlying statement we'll go back to look at one day. And that is the market has key strong support in the 1520 to 1540, 1550 area. And it has absolute key resistance in the 1625 to 1650 area. And a significant break below or above that, in my mind, will bring even a bigger move and propel that move even further, which means if it goes below, we're probably going to drop another 5 to 10% easy. And if we break above, we're probably going to make a run to the old highs. So with that in mind, I think new buying should be held off until we get those two closes above 1650. And if you're really concerned and can't live through a washout effect that I think will happen if gold did break below 1500, then put your stops right around there, or mental stops, and be prepared for a washout, and then have to see how it washes out before considering entering. Me personally, I'm in it for the long run. I believe the physical market and all the reasons to own gold are only going to get stronger as time goes over. So whether we do get a washout, I still believe, and believe we're going to make an all-time high, not a nominal high, but an all-time high where even taking into account inflation, we will be at the highest level. And that right now is somewhere between 2,300 and 2,500 based in U.S. dollars.
So, mother of all bull markets still prevails as far as you're concerned.
Still prevails with a key short to intermediate levels that, if taken out one way or another, as I just explained, will have an impact. But the longer term, if people have a year or more outlook, I still believe the mother of all bull market continues.
Okay, you mentioned some key points, 1520 at the low end, 16 and a quarter to 1650 at the high end. It'll be trading in between those ranges, and when there's a breakout beyond those levels, that's where that trend will continue. And that's what you're on record as saying, and I certainly respect your opinion on that. Any sort of timeline when you might think that a breakout one way or the other would occur?
Well, the bears have a few more weeks to so-called be in somewhat of an advantageous position. And what I mean by that is, and this is always seemingly forgotten by both the bull and bearish side, jewelry demand, jewelry fabrication is still the single biggest input on demand or lack of demand for gold. And jewelry fabricators basically take off from the late May to the mid-August period, return at that point to then prepare for their biggest period of sales, which is, early December through next February. Christmas sales, it's the single biggest worldwide of jewelry. So fabricators will start returning to their positions in the next 2 to 4 weeks, and we get into what was commonly known as a seasonally favorable period for gold, where obviously they are in the market and adding and needing to buy physical gold to make jewelry, et cetera, et cetera. Interesting enough, on a side note and a bigger picture, and maybe apply as much to mining shares as it does physical bullion, is we saw an article, and again I put it up today, that the ability to find good, high-quality gold deposits is becoming extremely difficult, and the producers are facing a much more difficult battle on a variety of fronts to maintain current production, with some concern that actually gold production could actually fall in the coming years. And I think that's even more possible now because of what happened to the junior market, the lack of capital or lesser capital that's going to go into that market that's going to lead to less deposits being discovered. So the physical argument for gold gets better after we get past the next 2 to 4 weeks. So the seasonality factor should be a positive. So if the shorts, or whatever you want to call them, I call them other names that we won't talk about in this interview, but they have about another 2 to 4 weeks before some seasonal factors will start to go against them.
Okay, we were talking about gold. You mentioned silver very briefly. Any further comments about silver and also base metals in general?
Silver to me, and this seems to disturb some people when I say it, but silver is a secondary metal next to gold. I think gold leads continually as a monetary, and the fact that it's so much more thinner traded and is clearly so much more manipulated, it's difficult to have it in the same league as gold, but I don't think it's too far away, and at times it tends to lead, and it gets dragged one way or another with gold. So since I remain very positive on gold, I believe silver will go higher, but I like to own gold first before I own silver. I think the base metal situation certainly can't expect a dramatic rise with such softness worldwide economically, but we're also seeing an unbelievable stance by copper, given all that softness, to still be substantially above $3, closer to $3.50, despite all this weakness. And part of that is that the expectation of oversupply has failed to materialize, and many analysts are now going to the point where they don't think there's going to be any oversupply. So base metals, I think, take a backseat to precious metals, and gold in the precious metals remains the most important one to own.
Okay. Moving from base metals and precious metals to energy, one of my favorite topics, as you well know. I assume that you're not bearish on oil, but that's not the case as far as natural gas is concerned.
Yeah, I had hoped that oil could get to 75 or below, but it ran into some very good support. I still think there's going to be a huge problem with a disruption in supply, because I'm still convinced that the Middle East doesn't get solved, the Iranian situation, in any talks with military action eventually happens. But I think it's also trapped by the general economic malaise worldwide. And so I think we're going to see a good trading range between 75 and 100 for any time soon. And the natural gas argument, there is no argument. There's certainly no bullish argument, because there's still ample supply. Until we see a real drop in supply and demand start to even off with supply, there's just no way it can rise dramatically. So I just think it's a market you need to avoid.
Okay. All right. That's an overview of the markets from a macro perspective. Let's go from a micro perspective and talk about some specific companies. Any individual companies on your radar that you'd like to talk about?
Well, they're all clients of mine. Most, if not all, that I speak about, I have positions in, which can be found out on my blog. But as much as I like to be very bullish, since my livelihood is, I think what I wrote a few weeks ago remains, that it's going to be a pretty tough market for the junior resource market for the balance of 2012. The only thing that can change that is gold getting above $1,650 and staying there. Could give us a more credible rally other than a decent bounce. But it remains very difficult, and going to get even more difficult as we get into the latter part of 2012 for many juniors. Having said that, I do think, some of the situations I'm involved in are going to be the exceptions to the rule. I mean, one, for instance, is, I've said this a lot of times, is Alderon iron ore. I mean, it was misunderstood how the deal was structured. People sold it off. These guys came out of the woodworks claiming it's a great short, which I thought would signal the bottom, which I think it has. They again made announcements that the deal is moving forward, and other pieces that necessary to turn the company into producer are falling in place, including port access now. And I think we're starting to see a bit of a short squeeze. And I think, another company that kind of falls into that mode much earlier in development, but a lot of exploration upside, is CapEx Ventures. I think, we're in what I've called, somebody earlier today, the Category 5 hurricane in the junior resource market. And there's going to be widespread damage. But some of the few that I think will be left standing basically intact is something like Donna Metals. Donna has completed all the things it needs to do. It will need to raise some money to move forward, but chances are, and certainly based on the market cap now, it's one of the few that actually can still be a producer going forward. And then I think we're going to start to see, based on the article I posted, that the majors are going to make a substantial move into the juniors. They're not going to pay up a lot, big-time premiums, but I think we're going to see more and more deals announced. Two of the companies I know I work for, I believe, this is not anything that I know is happening, but it's my own personal speculation, that are going to become very attractive takeovers if they're not already, is Geologics exploration. I mean, there's just so much upside potential there and real value, and then the other one is Spanish Mountain Gold. I also think when you look at some of these advanced stage exploration projects whose asset values, net asset values are so much more than their market cap. I mean, Sunridge Gold continues to fit that situation. And finally, and perhaps from prodding from myself, I think the company has demonstrated to me that they're finally ready to get proactive in the publicity of their situations now that they feel that their projects have advanced so much. And then finally, it's been a long, long time since I've seen a really good, pure exploration play that has world-class potential. And North American Nickel, a project that's just about to start to be drilled in Greenland, something I wrote about and encourage people to read more at the blog. It's perhaps the single best pure exploration play I've seen in years. But again, I want to reemphasize to everybody that an L-shaped recovery continues to be the way, and in my opinion, will be the way for the rest of the year unless we get a much higher gold price. And if you know what an L looks like, I think we're bottoming, and I don't think things are going to get much worse, but I think we're going to go through a period of consolidation and sideways, and we'll have little rallies in there, but the market won't be that much higher unless and only unless we can get gold moving substantially to the upside again.
Okay. On that note, Peter, that's it as far as the formal questions are concerned, but I will leave you the last word. Any final thoughts? Maybe it doesn't have to be business, but politics, sports, life in general. Any final parting shots that you'd like to make at this time?
Is it too early to talk about the Cowboys?
No, it's never too early to talk about the best football team of all time.
Well, I don't know what Amani Toomer was smoking or drinking, the former wide receiver for the Giants, when he said he chose your quarterback over Eli Manning because of statistics. I'll just tell you one thing I've learned. You can throw statistics out the door. At the end of the day, winning only matters.
That's true.
And Eli Manning has 2 Super Bowl rings, and Tony Romo has 0. So
that's true, but the Dallas Cowboys have more Super Bowl rings than the New York Giants.
But listen, that's when TV was in black and white. You got to get past that. We're in the 21st century now.
I think Troy Aikman and Emmett Smith were playing when there was color television and high def and all that good stuff.
Yeah, but you have to be 50 years old to remember them. So
well, I'm going to be 50 next month.
All right.
Did I tell you?
Right. If I remember something, you said something. Your wife got you some.
Yes, I hit the big 5-0 this year, and I'm going off to Dallas for the U.S. Thanksgiving. And I'm going to be on the 50-yard line watching my Cowboys destroy the Redskins.
Well, it's kind of like me. I wouldn't mind, somehow if they both tie and both lost, but I can live with that.
Peter, on that note, always a pleasure talking with you, and I look forward to talking with you maybe 2 weeks from now.
Okay, thank you, Al.
Okay. This interview appears on my website, corporateinterviews.com. It can also be accessed on YouTube and iTunes. Just type in Grandich in those respective search engines to not only access this interview, but interviews that we've done in the past. If you have any questions for Peter, by all means, send me an email. My email address, very simply, al@corporateinterviews.com. We'll certainly do our best to mention it on our next program. For Peter Grandich, I'm Al O'Grady. Thanks very much for joining us.